Hello and welcome to this video on liability. In this video we're going to look at the difference between limited and unlimited liability and then look at which sources of finance are applicable for different types of business organisation depending on their liability. I've said liability a lot, so let's start off with a definition, and where else to get one than the dictionary. So our definition of liability is the state of being legally responsible for something, or, as I've sometimes been described as in the past, a person or thing whose presence or behaviour is likely to put one at a disadvantage. In a business sense, we're talking about the first one. If a business is liable, it is legally responsible for something. So a business may be liable for paying back its debts or liable for complying with the law. It's legally responsible for these actions. What does it mean if a business has unlimited liability? Well, that means the owners of a business are responsible for the total amount of the debt of the business, and the owner may lose their personal belongings if the value of these is needed to cover the debts of the business. So an unlimited liability business is one where there is no legal difference between the owner of the business and the business, and we call this an unincorporated business. It hasn't really been registered with the government. Everything is carried out in the name of the owner, and these tend to be smaller businesses. So if you were to set up your own window cleaning service, it would be your name that you were acting in, and if you took out a loan to buy some supplies, then you'd be responsible personally for paying back that loan. So even if the business ran out of money, you might still have to sell some of your own personal assets to cover any shortfall. What are the implications of being a business with unlimited liability? Well, you're financially exposed to the failure of the business. You could be forced to sell off private assets to pay any debts that the business owes. You're also liable personally for any unlawful acts committed by staff. However, sometimes it's easier to raise finance as lenders. We're more comfortable they'll get their money back because not only is the money in the business there to be used, but also your own personal private assets. Some of the other good news, if you have an unlimited liability company, is you don't have to register with the government, and as a result you won't be paying corporation tax. Let's now look at limited liability. Limited liability means that an investor's liability or their financial commitment is limited to the amount invested or promised in shared capital. An investor's personal belongings beyond what they've put into the business are protected. They are not liable. So the amount that you can be asked to be responsible for is limited. It's not all your personal belongings, just the investment in the business itself. So a limited liability business has a separate legal identity to its owners, sometimes known as an incorporated business, and this means it's been registered with the government. Everything is carried out in the name of the business, not the owner's name. So for example, if you set up a window cleaning business that became a large business and you registered it, it would be Jimmy's Window Cleaning Limited. That would be the entity that was undertaking the work, not Jimmy personally himself. What are the implications of limited liability? Well, the owners of a business with limited liability are the shareholders, and shareholders cannot be legally forced to sell personal assets to meet the business's debts. Only the amount they paid for their shares is at risk, and as a result limited companies may find it easier to raise money from investors, as the investors know that if something to go wrong, how much exactly they would lose. There's no risk of losing any of their personal assets. So to do this you need to register with the government, and as a result you start paying corporation tax, but your investment in the company is your liability is protected to an extent because you can't lose any of your personal assets, only the money invested in the business. So business ownership and liability. Well, here we have unlimited liability and limited liability businesses. And the two forms of unlimited liability that we need to be aware of: sole trader with one owner and a partnership owned by a number of partners. These businesses have unlimited liability or unincorporated status. On the flip side, limited liability businesses, Incorporated businesses include private limited companies owned by a few shareholders and public limited companies owned by many shareholders. We're going to move on now and look at which sources of finance are applicable to which type of business organisation. And this table here shows us some suggested theory. So for example, sole traders would normally start off with personal sources of finance. Retained profit would only really be a source for a sole trader if the business is surviving and has become established. Now sole traders and partnerships, by definition, they are the business, so there are no shareholders. Share capital does not exist for these two forms. They can finance themselves through banks, perhaps using a personal loan or a mortgage, where owners borrow money and use their house as collateral. So if they fail to repay the loan because perhaps their business isn't doing very well, there is a risk they could lose their house. Crowdfunding could be a possible, but it won't be for an equity stake in the business, it won't be for selling share capital, maybe just a reward. Peer-to-peer is an option, maybe a loan, and other businesses are options, maybe a grant from the government, trade credit, or leasing. A partnership, the same applies as a sole trader, as these are both unlimited liability businesses. Let's look for private limited company. Personal sources might apply for a smaller private limited company, very unlikely for a public limited company. Retained profit would apply for both of these limited companies. Share capital would apply for both these, although for a private limited company it's normally sold to friends and family, whereas public limited company those shares would be available to the public normally through a rights issue, a big selling of shares. Venture capital, yes. Banks, yes, both loans and overdrafts. Business angels would apply normally to private limited companies, not public limited companies, likewise for crowdfunding and peer-to-peer funding. Public limited companies have used the public or stock market for a big share issue, so they have lots of share capital, but as a result would not be using these other sources of finance here. And lastly, other businesses, trade credit, leasing and other businesses would apply to both private limited companies and potentially public limited companies, perhaps for short-term sources of finance.